Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending September 9th, 2022. Appreciate you all tuning into this channel, subscribing to this channel, as well as our podcast, InvestTalk, and hit the like button. We'd appreciate that. Now, this week I am going to title the video, "The ECB rate hike brings a rally on dollar weakness." And I talked today on today's show a bit about the currency markets, and I'll dig into them in a little bit more but later. But I want to touch on the economic news that came out this week. The ISM on Tuesday was really the big one. It ticked up just a bit from 56.7 to 56.9. And that was just showing basically the economy is not really growing, it's not shrinking, it's kind of stagnant. But what was the most important that I was watching was that prices paid index. I talked about the correlation between that and CPI, and that did come down, a decent amount, 72.3 to 71.5, but not the dramatic drop that we saw from June to July, 80 to 72. But nonetheless, this should feed into weaker CPI numbers, which come out next Tuesday, coming up here in just a handful of days. And that's certainly going to be a big input for the Fed on what they do this month when it comes to rate hikes. You also have consumer spending data coming out as well next week, so those will be important for the Fed meeting the following week. Now, the new orders index that ticked up, that was probably the most bullish part of the report. Nice from 59.9 to 61.8, almost 2 points there. You had this employment index that ticked back up into positive territory. That was good, and that was reflective of what you saw in the initial claims report. That has been ticking down pretty consistently since early August, right? 252, 245, 237, right? Just continue to tick down, which is certainly a positive sign. But then you move over to continuous claims, and that does continue to go up. Remember, this is just the week-to-week filings, but how many people are falling off of those unemployment rolls and how many are staying on, that is more impactful. So we're at 1.47 million. Pre-pandemic, we were at 1.76. So, we're a ways away from that and there. And, the economy was pretty strong in early February of 2020. So, the labor market hasn't fully turned. It's usually the thing that turns later, but you can see the momentum is not fantastic, but it's not a train wreck either. So I just wanted to highlight a few of those statistics before we dig into the charts, which we'll do right now. Here's the S&P, and there's a lot of lines on this chart. So let me clean this up a bit. Let me just get that. Bring up the delete. Let's clean this up here. And, what's interesting here is see this downtrend line. And this is actually shaping up to be kind of an inverse head and shoulders, right? So you could use this shoulder, or you could even use this. I would probably use this because of that big breakdown level. And so, you have shoulder here, you have a head, you have another shoulder, and could this break all the way out? I would not rule it out, right? And basically, this is how you do an inverse head and shoulders. You take the neckline to the head, you copy that. Let's paste that right there, and then we're going to move it to wherever it breaks above it. So let's say here. Let's zoom out to a weekly, and that would put it at new highs, 5,000 on the S&P. Would that shock me? No, not really. I talked on Wednesday about how earnings up 5%, supposed to be up 5% this quarter. Okay. Now, am I calling for that? I'm not calling for that, but you have to be open to all possibilities. You can't be stuck in your ways and have one view of of the market. You have to call balls and strikes. You have to take the data, analyze it, and try to see both sides, the positives and the negatives. And so, this is a potential positive setup. But we're also in a downtrend, right? Lower highs, lower lows, and that's a negative setup. But negatives can turn into positive, just as positives can turn into negatives. All right, so I just wanted to highlight that. Now, another thing, and remember, there was a lot of sentiment. We were getting calls, and I was getting some really big vibes that like everyone was bearish here. Oh, we had the rally, it rolled over, it's over, we're going to new lows. It's really hard to have the market break down dramatically. Remember, here the market was down, S&P was down nearly 20% on the year, even though it was off its lows. To have that breakdown and get through that, you're going to talk about a down 30% on the year when earnings are up. Earnings are up. Now, granted, nominally, right? In real terms, they're negative if you subtract out inflation, right? You have nominal +5, you subtract out inflation of 8, you're getting negative 3%. But guess what? The numbers you see on this screen are not adjusted for inflation. You can adjust them, but that's not how charts and prices work in the market, okay? So I want to make you aware of that and get you to understand that that's why I wasn't too bearish on this market. In addition, I was looking at other things that are underlying the market. Look at small caps to the SPY. We're in an uptrend, right? If everything's going to hell in a handbasket, these small caps are going to be the weakest. Since mid-May, small caps have been the strongest part of the market. So something you have to keep in mind. Now let's look at growth versus value, one of my favorites, right? And that was kind of flat on the week, but kind of in a downtrend. So you still see this rotation out of value or out of growth and into value. That's not really changing, and I don't expect that to change in the long term. The VIX try to make a breakout here, and it's failed so far. Now it's not completely failed. It's not below this breakup candle here, but nice little pullback here, and we'll see. Do we break this candle next week? Do we move up on maybe higher than expected CPI number, or do we break lower on a lower than expected CPI number? Remember, lower VIX, higher equity markets. Higher VIX, typically lower equity markets. Now, I do want to look at the commodities market. Here's the USO. So oil was down today or this week. UNG, the natural gas. That was interesting because Russia cut off the Nord Stream 2 pipeline and natural gas fell on it. So I thought that was quite interesting. The good example of buy the rumor, sell the news type of event. Commodities in general down for the week. And that certainly helps those markets like Europe, like Japan. And now I want to dig into the currency markets. Now, here's the dollar. And the dollar definitely had a tough the last few days, but closed modestly lower on the week from this broad index. But if you look at some of the underlying currencies, here's the FXE, the euro. So the euro was up on the week as they tightened policy 75 basis points and kind of trying to keep up with what's happening here in the U.S. You also have the Canadian dollar. That one was nicely up on the week. This has been one of the stronger developed market currencies compared to the dollar all year. You can see it's in a downtrend, but not a strong downtrend. And a lot of that has to do with it's a commodity producer and exporter. And any country that has strong commodity revenue and commodity business, their currency tends to do fairly well in this environment. The yen, let's go over to the yen. That also looked like it tried to get a little reversal this week, but you can see still was down. on the week. Sorry, little reversal today, but certainly down on the week. You had pretty good volume here on the FXY, and the MACD is trying to make another series of higher lows. So I do think you're going to get a reversal in the yen. Inflation is heading up in Japan. They're restarting the nuclear reactors. I think that is a net positive for them. So I think that's smart. But overall, the strong dollar is a wrecking ball. It causes problems all over the world, especially in developed markets. So if you can get a turn in the dollar, either based on these other countries getting their act together, or just the Fed pivoting to a less hawkish stance, I think that could bring that relief rally. And there's a lot of people that are underweight equities, short equities, and I think our potential rally could be very strong if there is a catalyst. And we're entering this period with the Fed meeting, with CPI numbers, all of this that could spark something like that. So I'm on the lookout for that. I also want to highlight the EMB. This is the Emerging Market Bond ETF. I think I looked at this last week, but the fact that this is starting to make an uptrend means money's flowing into emerging markets, and typically that is not happening when the Fed is embarking on a tightening, continuing to be tighter with their policy. I talked about it last week how this broke down before the Fed actually pivoted. So is this breaking up and starting an uptrend before the Fed is going to pivot the other way? Something definitely to keep an eye on and be cognizant of. I also want to let's look at a few other things. DBP, this is the precious metals. Gold has gotten a little bit of a pop. You're starting to see this trying to make a MACD divergence there, but it's not nearly as strong as the base metals. Here's DBB. That's getting a little bit of a rebound over the last few days, definitely making a much better, higher low here, and the MACD trying to close above the zero line. So these are base metals: copper, zinc, aluminum, steel, etc. And those are important and a good indicator that the economy is relatively strong. Those stocks, those commodities tend to do well when the market or the economy is strong. Here's uranium. Uranium also broke out this week. Continue to get more and more countries pivoting back to nuclear and saying we can't, in this commodity environment, keep shutting down our nuclear plants. You had California reverse. You have, like I said, Japan restarting. You have countries in Europe that are also thinking about this and investing in it. So something that is important to keep an eye on. One of my favorite parts of the market right now. Then I want to look at the sectors, typically the cyclical sectors. So here's XLE, very cyclical. Look at this, much higher low. Let's look at, I'm going to look at XLF to the SPY. You're seeing that kind of break up here, right? So if we're going into, a terrible economy, usually the financials are not leading. They're not leading, okay? And right now it's leading the S&P over the past month or so. Same with, let's look at XLI to the SPY. So this is industrials. A little bit weaker over the past few days, just because you got that, I think, surge in growth stocks over the past couple of days, but still an uptrend. Okay, not breaking down. Here's IYM. Let's look at IYM. So basic materials. That one also had that pullback, similar to the base metals, very similar to the, that's materials, base metals, very, very similar. That's starting to get an uptrend. Look at the MACD, just kind of grinding higher. And then lastly, we know what XLE is doing. That has pulled back this week. So I'll do XLE to the SPY. A little pullback this week, but in an uptrend. Overall, the signals I'm getting is short, medium term, you kind of have to be more bullish. I know it's weird. You have the 10-year pushing up to 3.32. You have mortgage rates really, really pushing up. Let's go to Mortgage News Daily. This is always a good one. It's Mortgage News Daily. We're at 30-year fix, 6%, basically 5.97. Let's look at the futures. What is expected for the Fed rate hike this month? we're still at, we're up to 91%. Yeah, basically locked in. Hey, we're going to be at 91% chance there's going to be a 75 basis point hike in a couple of weeks. And, the market's not phasing the market. Really isn't. Everyone wants to get bearish on it, and you have to really call balls and strikes. It seems obvious, but, the market oftentimes does not do the obvious thing. Usually doesn't. So this is why you want to stick with the facts on the ground and not the narrative that's out there, which is, the economy is going to hell in a handbasket. It's certainly weakening, and we may be there. We may be in a recession 6 months from now, a year from now. But that's not what we're seeing in the data. It's not what we're seeing on the charts. Okay? So take that for what you will. And I want to wish you all a wonderful weekend. And a reminder that the contents of this video are provided for educational purposes only. They are provided for educational purposes only. They should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. Appreciate you all for tuning in, and have a wonderful night.